the weekly rate update. I'm Craig Fuller, here with John Paul Hampstead. It is September 27th, end of the month, which that means lots of activity in the market.
Right, and into the quarter as well. So
that's right, even more importantly.
You know, one of the things we've been looking at is kind of like trying to anticipate how truckload carrier and 3PL earnings are going to go. You know, are they going to be able to guide, well for the fourth quarter based on how the third quarter ended up and things like that. And we're hearing some like really positive read-throughs. At least in my conversations with brokers, I'm getting the sense that they're saying that they're seeing more hot loads. It's taking them longer to cover the loads on their boards. And the guys I was talking to this week were basically saying that truckload carriers, the big enterprise fleets, have achieved the kind of asset utilization they're looking for. And now they're kind of rotating out of some of the less desirable freight toward stuff that's really profitable. And that those loads are sitting on the docks and eventually getting passed through to the brokers.
Yeah, I would say I share the same thing. I mean, back in the end of July, the thing about this being the end of the quarter, we actually called the market turnaround. Because about the 20th, I can't remember the exact date, 23rd of July, there was that crossover of 2019 volumes over 2018 volumes.
Right.
And so looking at, from a volume perspective, we've seen increasingly firming conditions in the market. Now, rates have not followed up, but volumes have. And I think to your point, the larger asset carriers are now getting the desired utilization. We're headed into peak, and they're allocating capacity towards those retail peak, e-commerce,
Exactly.
the e-commerce players that they tend to do pop-up fleets. I mean, this is the thing that people don't understand about the larger asset enterprise carriers.
It's more about yield management than average rate per mile.
It is yield management, but it's also about, in this time of the year, they get opportunities to do a lot of pop-up fleet activity. So they'll sell a FedEx, a UPS, a Amazon, 100, 200, 500, maybe more trucks for these tours where the e-commerce retailer or the air freight forwarder will end up buying that capacity on a weekly basis, and they will dedicate the capacity. You think about that, it takes some of the capacity from the over-the-road market for those larger carriers, and so what they're doing is they're cycling through their routing, what they're offered, and they're allocating capacity towards shippers that they really want to do business with. I think this is a situation where that term shipper of choice actually matters when you're talking about going into peak, because it's going to be the shippers that the carriers want to do business with, whether it's year-round consistent volumes, shippers that they perceive taking care of them. All those things are going to matter in the fourth quarter, in the peak, as we head in.
Yeah, and especially as carriers have more options, I think that's important. As far as rates go, we're seeing the national average dry van spot rate, exclusive of fuel, still around $1.45 a mile.
You're talking about the long haul rate average.
Yeah, $1.45 a mile. Lanes like Chicago to Atlanta are still moving up, so that's over $2 now before the fuel surcharge, which is a very good rate. Obviously, Atlanta to Philadelphia is above the national average. It's around like 168. Any things going into places like Seattle, obviously high. So
those will always be, even if those lanes that you mentioned are always going to be above the national average. I think the question is the increase, the delta of those movement up higher than the overall market? Because that would suggest that what's happening is that carriers are being selective in terms of which lanes that they're avoiding. So if you're taking a load into Seattle or you're taking a load into Philadelphia, you're not wanting to run it because you may have better options in other markets that don't put you into a backhaul market. So those head haul lanes are going to move first, typically in price upward movement, simply because carriers tend to price those higher when they have other options.
Yeah, and so to your point, rates going into Atlanta moving up, we've heard that the southeast is pretty loose, that coming out of the southeast,
just in terms of available capacity, it's pretty sloppy.
Capacity to volume. Whereas in the Midwest, the brokers I was talking to this week said that there's sort of the Midwest belt, if you think about it, from like Arkansas up through like Missouri, that area is still pretty tight, even for reefers as well.
Now, is that a function? I mean, it's grain season now. I mean, we have harvest even coming up in places like Minnesota,
Right.
that upper Midwest. Is that having an impact on just demand in the Midwest, or do you think it's industrial? The auto plants have shut down. Like,
I think no, I don't think it's necessarily industrial. I think it's ag. I think it's food. I think it's beverages. I think that we've had a lot of the country has had sort of deep summer high temps extend.
Tell me about it.
For longer,
like, especially in Chattanooga, Tennessee.
Yeah.
So like it's been unusually hot this September.
Yeah. Even at the end of September, temperatures in the 90s every day. So that extends the demand for beverages, things like that. So I think that's playing a part of it. And on the East Coast, it's hard to say. Port volumes have grown a lot on the East Coast relative to the West Coast. I think that matters. And I think in general, what I've been hearing is that what's happening now on the broker side, higher volumes, higher revenue per load, higher margins per load finally. This is kind of the surge, the peak that they've been waiting for.
And that's predominantly going in terms of the brokerage margins or the brokerage are seeing.
Yeah, so they're not
as
seeing
you
spot
mentioned,
come up necessarily.
So they're still seeing a available capacity in the spot market, but they're able to charge or benefit from higher paying contract freight, which is increasing their margins.
Yeah, and specifically, William Kerr at Edge Logistics told me that where it was taking him sort of a record low 9 minutes to cover a load, kind of earlier in the summer when capacity was super loose. Now that number is bumped up to 15, 17 minutes a load, which is not a bad thing because they want to be able to charge for their services. They want to, if anyone can find a truck, it's hard to charge money to find a truck.
Yeah.
So it's a good thing for them.
Yeah, well, that's certainly encouraging signs for the freight brokerage business. Yeah. Less encouraging for those carriers that operate in the spot market. But we are seeing signs of the larger asset carriers firm up. And when that firming happens, then some of that secondary freight that will end up in the spot market and certainly benefit the smaller carriers.
That's what's interesting to me. I mean, this is kind of a longer term thing to think about, but we hear so many trends about automated freight matching, automated load matching, right? When you think about a market like we have today where there's spotty regional tightness, pretty steady rates on an average basis, but for wide variance between lanes and markets, you would think, okay, if I'm a small fleet, if I'm an owner-operator, I really want to play this strategically. I want to go to shippers I know that have freight. I want to go to markets I know that are tight. I might be willing to go out of my normal network to make some extra money. I don't know how like an automated freight matching solution really helps you do that. You know what I'm saying? Like the guys who know how to play the market, I don't know if the technology that's being used by brokerages, by big fleets, even by sort of marketplaces, adds value in a situation like this.
In terms of
being opportunistic, being strategic, and if my goal as a truck driver is to maximize my revenue per week, not necessarily to stay in a certain network.
I mean, I think a lot of the investment in matching has been the brokers, and they're the ones that are benefiting from that. Effectively in freight brokerage, you make your money by what your margins are.
Yeah.
And so your entire investment thesis is how do I increase those margins? And I can do it either by finding more efficient ways to buy capacity, or I can find more efficient ways to charge higher rates and secure more business volume, and then mitigate my back office costs. And some of the ones that have invested a lot of money have been very successful at that. I mean, I think the marketplace models where you have real-time bidding, JP Hampstead's example is where there's a more dynamic market. I think that's an example where What they're doing is just responding, creating a more transparent market and creating
Right.
more market conditions.
Right.
But a lot of the investment, just broadly, has been to help those guys secure more loads and more capacity. I don't think that yet we've seen the assets really benefit from a lot of that technology.
And it's almost like the more I think that if you're inexperienced, if you're new, if maybe you don't have the language skills to negotiate with a broker effectively, you can really benefit from automated load matching. Where it shows you loads that you're likely to want to do.
I think if you operate in the thesis, which I do, that utilization is the most important thing, keeping my truck running at all times,
Right.
regardless of rate,
Right.
then I think the digital brokerage business has been a resounding success, because what it's done is it's provided this ease of access of
Liquidity,
freight that I've never had access to. Now, does it result in higher rates for the carrier? And I don't know yet.
And what happens in a market that's heating up, where the carrier is hearing about, there might be money to be made going outside of the loads that are being shown to me.
In theory, you have a digital brokerage with sufficient liquidity, in theory, then the digital brokerages should be responding to those market conditions more dynamically and more in real time, which means when rates go up, I'm a beneficiary of that if I happen to take a load at that moment in time. Now, I don't know, and if there are digital brokers listening to this show, I would love to have them on here to answer this question, or reach out to John Paul or myself to actually answer the question: can you substantiate that the asset-based carriers, the carriers that are hauling your freight, are actually benefiting from a higher rate by taking loads? I can make the argument that they're benefiting from higher utilization and more freight opportunities.
Right.
I don't know yet, and I'm not saying it's not happening. I don't know yet that we've seen higher rates being passed on to the carriers. I mean, it's the example of Morgan Stanley did that analysis on Uber Freight, and they said that 99% of the revenue gets passed on to the carrier. When you read that, you're like, wow, Uber is basically giving a lot more of the money back to the carrier. If you actually read into it, what they're doing is they're lowering the price to the shipper to get access to the capacity. There is no evidence that I'm aware of that they're actually doing it.
Are actually paying
and this isn't a fault of any of the digital brokers. It's just a reality that until there are conditions that they are forced to compete on capacity, then we're not going to see increases to the carrier that they're going to benefit. Now, they benefit from higher volumes, and I think the number one rule of running a trucking company is always have a load. Keep that truck running. Right. And I think they can absolutely make that case, which in the end of the day should be their case, is what do you take home at each week? That's what we're doing for you. Don't worry and get caught up in what you're making rate per mile. Worry about what you're taking home each week, because that's really the important factor. And if you're a digital broker, that's the case you make. Now, can you prove?
But that's what's interesting. If you think about it from like a game theory perspective, people's strategies, start changing. When the market shifts, the rules of the game change, and players think differently, right?
But if the digital brokers are successful doing what they want to do and aspire to do, they will be responding to those market conditions in a more real-time manner than they ever happened. And they'll create more transparency in there. And what will happen is the carriers will benefit from knowing the market at that moment in time. I'm not convinced that any of them have sufficient enough liquidity, sufficient enough density in their networks to be able to substantiate that yet. I do think it's coming. And I think in the next 5 years, carriers broadly will benefit from the digitization of this business. But I have yet, and I'm not saying it's not happening, and I would love to see it, I'd yet to see anyone that can say we are raising the rate per mile of carriers that are on our app and are absolutely taking loads. I believe, and I would love to see the data as well, them to show that they're increasing utilization, because I absolutely believe that's happening. I just don't know on the rate per mile, and I would be a little bit.
I think part of the pitch to the shipper on the other side of the marketplace
they're eliminating inefficiency. It's the human. They're taking the 12 to 18% margin that used to be passed on through all that human cost and digitizing it and making it more transparent and more electronic, and hopefully eliminating some of that back office cost. That is benefiting the shippers. which ultimately is good because they're able to capture more share, which increases density. That's what I would do if I were running one, frankly, is I would want the volumes.
Right,
and I would be willing, if I'm running one of these, I'd be willing to give up significant margins if I had venture capital, consistent venture capital, and ran through it. One thing I did want to talk about, you wrote a really interesting piece, and I want to spend, we just got a few minutes left, I want to spend a few minutes on the WeWork story that you wrote 2 days ago about how WeWork could be the end of that negative unit economic cycle. I'd love for you to dive a little bit into that.
Yeah, so we've been talking about WeWork for a long time in Slack and stuff like that, and trying to figure out, is there a freight angle to the story? It seems so important for venture capital, for the way that companies make the transition from private markets to public markets, and all the implications that has for valuation strategies in a SoftBank world, right? It's Moss's world. We're all living in it.
Maybe not long.
Yeah, we'll see. So what we ended up coming up with was talking to some venture capitalists and really saying, they kind of told us, look, unlimited revenue growth on negative unit economics is done as a model. If you're a marketplace company, what's going to matter are your gross margins. And
it goes back to unit economics, is the idea that you're going to subsidize to grow, but lose on every unit you sell. And in the world of freight matching, if I am taking investor capital and subsidizing my marketplace build, but I have no margins, I'm generating zero gross margins in that, then that could be a really warning sign for companies trying to raise the next round. They may have been successful raising a little bit or a lot of money,
right?
But if they can't go to their investors and show that they're gaining on that unit economics, i.e. the margins and the take rate, and it's not positive, they may struggle at raising at the same size of the round or the next round. Now, having said that, I did talk to one investor last night that said that some of the larger guys, and they mentioned specifically Convoy and Flexport, may have actually already reached a point where they've gotten so much critical mass that investors will look at them and not be as concerned short term because they're so dense that they may be able to optimize their model because they're so big. Some of the second tier digital folks may struggle a little bit on the next round of capital. It also, ultimately, valuation is going to be the driver of this. I wouldn't be shocked if we see a couple of down rounds or some middling rounds as the market starts to digest these things. It seems like businesses with negative unit economics are probably not going to be in favor for some period of time.
That's right. And you wonder, do these companies, if and when they go public, what are they treated as? Are they treated like, I kind of made the argument, halfway serious to some equities analysts who covered 3PLs when Uber went public. I was like, so are you going to be covering Uber?
I actually wondered that.
And they're like, no, they're an internet company, they're a tech company.
They're a tech, yeah.
I'm like, yeah, but it's just an arbitrage.
They're a transportation company, right?
Yeah, and so
well, that's not where they want them, because frankly, if you're a sell-side research group, you want to be selling research to tech. I mean, we've seen what happens to freight research.
And there's politics within the research division.
But honestly, you want to, I mean, the money's all in tech investing and momentum investing, and you put them into an industrial, which is where they tend to put the transport stocks. Right. Then you're talking about an uninteresting sort of sector. Right. So this is all, there's a lot of gameship. Now, the interesting thing is, take JB Hunt 360. JB Hunt 360, according to their numbers, is over $1 billion run rate. Had some small unit economic gains, a couple of percent of margin, but lost a little bit of money. And they're getting zero credit for this asset inside their business. Right. You sort of break up their stock. Conceptually, that's a $3 to $4 billion, if you sort of take Silicon Valley valuations, $3 to $4 billion market cap. But it's public, and the public markets are not getting credit. We'll see what happens in the next cycle on fundraising. We know there's a lot of activity.
IPOs.
Well, IPOs, I think there is a lot of case to be made that negative unit economic businesses are probably going to struggle. That's my belief. But having said that, we'll see what happens in the freight space. There's not a lot of companies. I don't think there's any freight tech company, marketplace company, that actually could do an IPO at this stage. It just isn't. They're not big enough, or they're not profitable enough to actually do that, and a combination of both. So I think it'll stay private for a while, and that may give us time to sort of see how this resets. But it's certainly going to be interesting to watch. I know you'll be watching it.
Oh, yeah.
We'll certainly be covering it through FreightWaves. Speaking of freight tech, don't forget on November 12th and 13th, we're hosting the Freight Tech Party of the Year in Chicago, Illinois at the McCormick Center. FreightWaves Live is the ultimate freight event where we bring the top thought leaders from the space, combine it with the most immersive technology, and we have an amazing party atmosphere. So join us at FreightWaves Live. If you haven't gotten tickets, remember, they go up on October 1st, so be sure to get them today.
Our industry is moving faster than ever. Where are freight volumes headed? How will this affect capacity? And of course, what's the newest technology that can benefit your business? Those questions and many more will be answered at the industry's hottest freight tech conference this November in Chicago. Come join us at FreightWaves Live November 12th and 13th at the McCormick Center. Visit FreightWavesLive.com to register.